Good afternoon, everybody. Welcome to the TraderMerlin show. What's going on over there? It is your what do we have? We're Wednesday. It's the Wednesday edition. Corey, mute your monitor, would you? It's your Wednesday edition of the TraderMerlin show. It's gonna be a little bit different today. Obviously, we're gonna run through some of the things that are going on in the markets and what's exciting on that front. But many of you have asked to have Corey and Traders Army back on the program. I thought, why not? Let's get Corey back on the program. And then the question was, what on earth do we talk about? What sort of stuff you want to discuss? And many of you have sent in questions on specific trade setups. I've got a question on hedge funds. I've got questions on implied volatility. It's like, okay, well, let's talk about that, or unusual volume. We'll do a whole bunch of different stuff today. That's really the goal for today's program. Joining me today from sunny and incredibly hot Southern California, we've got Corey Lane joining us. Corey, welcome to the show, my friend. Uh-oh.
Yep, can you hear me now?
There you go. Gotcha.
Yeah, sorry about that. That was a lot of noise in the beginning, wasn't it?
It was a little weird. A little bit weird. I'm trying to...
Sorry about that.
No problem. It's okay. I've got my wonderful graphic for you, too. Getting all the audio set up is always a fun endeavor over here. So, here we go. Got you all set up. How you been, my friend? What's going on?
Man, I've been really good. It's just, nonstop fun as always. Glad to see that the summer finally came in Southern California, and it's good to be back, man.
Yeah, it's getting hotter and hotter, man. It's funny because I was complaining on how cold it was and rainy, and now I'm going, I wouldn't mind some like cloudy weather again. It's toasty up here.
Yeah. I have my second AC repair guy coming out in about an hour because our AC has been broken for the entire heat wave.
Wow, nice. I had an AC guy. I had two AC guys come by. Actually, one guy listens to the show, said I will volunteer to come by and fix it. Both could not do it, and I'm looking at $16,000. I'm like, man, really?
Yeah.
That's not fun.
You need a home warranty, son.
A little too late for that. As the title of the show was called, the options nitty gritty, I thought I would ask a couple different questions that come through, and I'll start with one that deals with unusual options volume. Now, there are sites, there's even portions to different websites that will dedicate it to, hey, here's unusual options volume, and they usually make an issue of it on CNBC. I personally don't use that information, but I'm also not as entrenched in the options world. I'm a casual options user. How would you say that you utilize the unusual options volume when you see some crazy block come through of options trade? Does that impact your decision?
No.
That was easy.
No, it doesn't. Next question. No. It never really used to. Like open interest never really, other than are the options liquid enough to be able to get in and out of? I look at open interest and I look at, the more the better. Volume, and specifically unusual volume, I never really paid attention to volume either. And I especially have decided, it's not even up for debate for me anymore. I have decided that volume especially is extremely useless when it comes to options, especially the unusual stuff. And here's why. Today, I shit you not, sorry.
You can curse, it's okay.
I spent 3 hours, and I manage. He's taken some money out, and he's you probably know Merlin, that I manage a private fund.
Yep.
Which is a hedge fund, but it's private, no money coming in, other than his own and his business associates. And so, I kid you not, it's a vertical spread on a stock that we've been trading now for probably the better part of 8-9 months, and rolling some options every month. If the position made money or lost money, we roll it to the next month and roll for a net credit. And the desired outcome is hopefully the stock rallies in the future. But in the meantime, we're collecting premium and we're rolling every month.
Right.
I kid you not, 3 hours today, I rolled 18,220 contracts.
Woo, mama.
Each leg. So I rolled out of those. There's 36,000 right there. And then I rolled back into the August version of that same spread, 18,220 per leg again. And if you consider all of that volume, it really wasn't anything but me managing a trade. Mm-hmm. It had nothing to do with my directional outlook in the stock. It had nothing to do. Obviously, I have a directional desire. I hope the stock goes up sooner than later. It only has to go up another, probably 20 or 30 cents. for those options to be out of the money because they're credit spreads or, short puts, things like that. And so I'm like, that's just little old Corey managing a $20 million account, which is not big. And that means nothing, but that's going to show up on some unusual volume screeners.
Right.
And it generally, to me, really means nothing. And we've got several positions that we are, significant volume. We are a significant portion of the open interest on these options. And it really means nothing if you look at it as an outsider. Doesn't mean anything.
Well, it does to an extent, because what it means is someone can look and say, okay, here's the spread that I'm looking at, or here's the specific strike price that you may be looking at. And they might be able to use that to their advantage, right?
If they knew what I was trying to do, like I've always kind of positioned open interest and volume as sort of look at all that volume, look at all that open interest. Yeah, but what is all that volume? What is the reason for all that volume? In our case, we're nursing a losing position. And so is that really that meaningful? Even if you knew, not that you could know that as an outsider looking at some unusual volume, screener on a website, you wouldn't know that I'm nursing a losing position. But for all you could look at that and say, look at somebody really must like these puts, or somebody must really like these calls. Second thing is you don't know what side I'm on. You don't know if I'm on the closing side or the opening side. You don't know if I'm on the buy side or the short side. And so there's so many unknowable factors that I feel like looking at a lot of volume and open interest parameter, like things like that, other than is this a liquid series of options? I feel like that's a distraction from what we should really be focusing on, which is underlying price.
It's interesting that you say that, because I was gonna, if I had to wager, I would have said the exact opposite. I would have said differently. I would have thought Corey's definitely looking at that stuff because it can help him pinpoint executions and stop losses and things like that. Because I was told years ago that it's really crucial and really important to look at it, and I tried with some of my stuff. I gave up. I found I was spending so much time trying to follow the unusual volume or big open interest areas on specific strike prices and make trades that way, and it didn't really pan out for me. So I'm like, I got other things to worry about that I think is going to be easier for me to read.
Yeah, there's some things that I've experimented with in the past, which is, max pain, which is look at where all the open interest is, and the market's going to try and move to that max, to where most of the open interest is, to cause the options to expire worthless, and there's less that the market has to settle at expiration. And, sometimes it worked and sometimes it didn't. And it's just sort of like, well, if I don't really have any particular odds in my favor for looking at information like that, to me, it's just very distracting. And just going back to how I use open interest specifically, it's nothing more than a measurement of liquidity. And, I think everybody who's watching the show right now probably can appreciate the more liquid something is, the easier it is to get in and out of. And that's been kind of the main thing that I look at when it comes to open interest.
When you mentioned volumes, obviously there's two different volume measurements, right? There's the open interest on the options itself, which of course is a measure of liquidity, but is there a higher level of volume, meaning the underlier itself? So if something's got, let's say, 1 million shares traded a day on average, there's no way you're going to get 18,000 options contracts out on that thing. Whereas if it's something like the S&P that's trading 25 million a day, on SPY, there's a lot more liquidity there. Is that kind of a starting point when you're looking for the option set that you're looking to trade?
Yeah, it absolutely is. One thing that kind of filters out the stocks that I even look at is I need 1 million shares per day on average on the stock, because I know if I'm not at least getting that, then I know especially for the fund, we're not going to get nearly the open interest we need or would like to have. Now, for a small options account, yeah, you can go trade, something that has 800,000, daily volume on the stock and, maybe a few hundred contracts open interest. But if you're talking, I have to manage a position tomorrow that's almost 9,000 contracts. Unfortunately, in that scenario, again, it's one of, we've got 30 positions a month we put on, but these are 2 positions that we've been nursing now for several months. And unfortunately, we have become the open interest on some of these contracts. And so, speaking first-handedly here, it's very difficult. It took me 3 hours today to work that order because we were kind of a lot of the open interest.
Right.
Not all of it, but it definitely is something to keep an eye on when you're trading options. You do not, if you can help it, you do not want to be a majority of the interest and a majority of the volume, because you just won't be able to get your orders filled quickly and at a great price.
Right. So with that, so obviously you have some pre-existing positions that you're doing options against, and okay, fine. If you had, I'm assuming that if you had to do it all over again, you'd look back and go, okay, we're not going to trade this one because it can't handle the kind of volume that we're looking at. Let's go for something more liquid on the underlier.
Yeah, and it started out very liquid, but when you have to manage a position and you roll it a few times, and especially when dealing with rolling short put options, every time we can, we're trying to sell a put to collect a premium, and if the stock drops below that price, we're going to try to roll those puts down, roll those puts out to a different strike price, maybe ideally lower strike price. And what happened on some of these positions is that we roll down to an option that's not as liquid as the one we're rolling from.
Mm-hmm.
And so now we're in a position where, well, now we are a lot of the open interest on this position, whereas before we were not.
Right.
And so, but there's a difference between starting a position from scratch and fresh and making sure that you're a small portion of the overall interest. And then now you're just in trade management mode. And it's just sort of like, well, I wouldn't choose this position. I wouldn't start the position with this open interest, but here we are, and I'm going to manage this position and I'm going to see it through. And that's kind of the situation that we're in on this, in this scenario.
Right.
And I'm looking at the chat box over here. Who is we from Margaret? Me and the guys that I'm managing this account for. And well, so what I use the word we because I'm managing a large fund for a friend of mine who's got some associates that I'm kind of consulting with.
There you go. It's not the royal we, not the royal we.
Not the royal we.
Yeah, and for those that might be listening along, going, oh, okay, all this. Again, for most of us, myself included, I mean, I think that the biggest position I was in was about 500 contracts, and for me, that was like a monstrous position. But for most of us, the considerations that Corey is dealing with, we're probably not going to experience that because you're not trading that big. You might have 20 or 30 or something. That's fine. But right. I think liquidity is critical. Make sure you always have enough liquidity in whatever it is that you're trading to accommodate that size, and don't be the one who's pushing the market because it's not going to work out well for you.
It's tough. And we do have a few members at Traders Army who trade in the several hundred contract range every month, and one person in particular I know has been on the wrong end of, you are the open interest.
Mm-hmm.
And your spread on $1, you've got 75 cents bid by $1.80 ask, and it's like, where are you going to get filled is anybody's guess.
Yeesh. That's a hell of a spread there, bud.
It's like, you are the interest. What do you expect?
Right. All right. Let me go through. I'm going to try to go through all the questions that were sent in. Of course, I always encourage you guys to send in questions to TraderMerlin@gmail.com, where you can put them down below any of the YouTube videos, and I usually get to those. So here is the one that came in from Tom, who's with us here today. The question is, how do I manage an options trade that relies on an underlying being in a range, but may pop out of that range for a short time? I could have a hard stop on the range, which would book a loss. This doesn't let the trade, quote unquote, work. And in most cases, the trade comes back to a profit. Occasionally, it doesn't return before expiration, and that ends up being a loss of about 3x of typical profit. So it sounds like a question of the specific strategy that Tom is using. Do you have any thoughts on that?
Yeah, so if it's a range-bound strategy, are we talking iron condors or any sort of vertical credit spread? And I guess
the Russell's one of his favorites for that one, which ripped out today, by the way.
Yeah, it did. Which I mean, it's been kind of showing a lot of relative strength lately, hasn't it? I mean, I've had that happen several times. I mean, iron condors specifically for us in our trading rooms have been kind of a little bit of a thorn in our side. And I'm very particular about what stocks or indexes and when we use, range bound iron condor strategies. But it almost seems like nowadays, with the significant amount of volatility in the market, every time we throw an iron condor on, it seems to want to break out of the range almost immediately. Now, in my case, my experience has been it breaks out of the range, the stop loss is triggered, the loss is somewhere in the neighborhood of 1 to 1 relative to reward, 1 to 1. I know you mentioned 3 to 1. When I establish the position, I establish enough credit, or I don't take the trade. I establish enough credit to make sure that the risk is never more than 1.5 to 1. And in a gap scenario, 2 to 1 at worst, right? So I think the first thing is you've got to look at risk relative to reward, relative to probability. And so I look for 15 to 20% of the spread value. So on the rut, if you're using $5 spreads or $10 spreads, I'm looking for 75 to $1.50 in terms of credit. That'll minimize the risk. As far as like waiting to see if it comes back in the range, in my case, in my experiences, once it breaks out of the range, it hits my stop, and it's maybe frustrating in that moment because you're like, dang it. But 9 times out of 10, it was the right decision. And price keeps moving further out of the range before coming back in, more times than not. I would say that if you've got a situation where more times than not it comes back in the range, then maybe you don't close it right away. But then you are risking a much bigger risk on those, much bigger loss on the ones that you decide to kind of hold on to and let follow through. In my experience, once the range has been broken, it only gets worse from there. So I just close it and move on. And the bigger thing for me is making sure that the risk is not more than 1.5 to 2 times the reward. Then you only have to be right on 7 or 8 out of 10, and you can be wrong on 1 or 2 or 3 and still be net profitable. But I know the feeling of it just bouncing out of the range and then bouncing out. And also making sure that again, focusing on underlying price action is important. I've seen way too many people focus on premium alone and delta on the short strike as a measure of probability, and put more weight on premium and delta than they do what is the stock actually doing price wise, right? So I think those things should probably help with that.
I'll bring up the chart over here for the Russell, and Tom, and thanks for the question. I'm glad you sent that one in. I think there isn't a definitive answer that's like, oh, you should always do this, right? I think it's just you have to set your rules, and for you, if you're using this range-bound Russell trade that I've got illustrated over here, I'll just put some lines on it, and you guys can see the yellow box on the right-hand side of the screen. I agree with Corey. Like, for me, there's a reason we would set this trade up, because I like to see it in the, I want to see it go range-bound. If it does, great. That's what I think it's going to do. And if it doesn't, then I'm wrong. So I have no problem. As soon as it gets above my stop price on the underlier, I'm out. And I know your pain, because I've done this before, not just with options, but with equities as well. When you get stopped out, and right as it takes out your stop, it's like, oh, did we just take Tom out? Okay, well, screw that guy. Let's just rip it right back down. And let's show him he would have been a huge winner, right? It's going to happen to every one of us. It drives me absolutely bonkers. But it's kind of like blackjack, right? I love blackjack, and if the dealer's got a 6 up, and I've got an 11, I'm doubling down. There's no question about it. I've got a 6 and a 16, and the dealer's got a 6. I never hit, right? Why do we have those rules? Because it's probability in my side. If something's been range bound for some time, the longer, in my opinion, the longer it goes range bound, the more likely when it breaks, it's going to rip and find a whole new set of supply or demand zones. So I think you got to just nip it in the butt. As soon as it hits your stop loss, wipe that trade clean and move on to the next one, and don't worry about it. It's just a casualty of war, of the trading war.
And that works when your risk relative to reward is in line with your expected outcome for a basket of trades. And I think that's where a lot of traders, especially a lot of traders that I've mentored in the past, they focus on 1 or 2 trades at a time. And what I've learned over the years is that if you consider the basket of trades, 10 or 20, and I've got probably in the fund, we have probably 25 on now. In my personal accounts, I have, we closed out about 7 or 8 of them in the last 2 days, but I had close to 30 trades on at once. And so I don't look at any one trade as the problem. Mm-hmm. And so that is probably the hardest part about only trading the Russell, or only trading Russell and S&P, or only trading one contract at a time, even if you're day trading futures. It's like, you feel only as good as your last trade.
Mm-hmm.
And I think if you look at it as a basket of trades, you'll realize that the more activity that you produce, while still maintaining discipline towards your rules, but the more trades you can find, the more that loss or that risk will be absorbed by the other trades that you're naturally just going to win on due to the odds in the
Right.
in your strategy.
You know, and I mean, what you're explaining is essentially the same thing as a mutual fund manager, right? They've got 200 positions in their portfolio. They could care less if one of them is losing, but they'll go back through and monitor it and say, oh, you know what, that one's down a bit too much. Get rid of it because I've got a whole bunch of other ones that are balancing that. And you're right, it's really difficult, especially for people who are trading one thing. It's the proverbial all your eggs in that one basket. And I think it's a bit more pressure. You have to be more precise, and it's harder to do. I like having multiple positions open in my accounts as well, just because I know I'm not going to be right all the time. Heck, I hope I'm right more than half the time, right? Let's hope that that's our winning probability. But I got to make sure I cut those losses out before they turn into something bad. And you know, I have no problem being wrong. I'm okay. I actually don't mind being wrong at all. I just can't be really wrong.
Yeah, being wrong these days does not faze me because I'm in so many trades at once. But being wrong when I was only trading a small handful of things, as I was super timid and getting started and had more limited capital, I was either an all-star that day or I was just the worst trader in the world. And the emotional roller coaster that I felt trading such few products at a time, trying to just hone my skill on those few products, I've never been through such an emotional roller coaster. And I'm just like, screw it. I'm just going to trade whatever comes up and I'm going to max out my buying power. And I'm just going to go for it. And ever since, the emotional side of things and just the overall account growth, the confidence doesn't get rocked quite as easily.
You know, take note of that one. He said he's never been on such an emotional roller coaster. Mind you, Corey is married and has kids, so that should tell you how volatile the emotions of trading can be.
It was a nightmare. I probably quit 18 times.
No.
Here we are.
There you are. So that was Tom's question. Let me go in. I got two more, and then we can kind of go into free form here. This one is from David, just sent in. So, David, thank you for that one. That was to tradermerlin@gmail.com. Do you have any thoughts on 5-wide versus 10-wide SPX for credit spreads? I like the 10-wide as I don't look for 100% profit, and I get quicker my desired percent of premium faster with 10-wide versus a 5-wide spread. And also when price goes against me, I'm down less with a 10-wide than I am with a 5-wide spread. So any thoughts on 5-wide versus 10-wide SPX?
Well, that's a great question. Yeah, it's a really great question. I generally prefer more narrow spreads. And dealing with SPX, you can't really get more narrow than 5. But if you look at like SPY, you can get as narrow as $1. I mean, some of these you can get as narrow as 50 cents. But the reason I like the more narrow spreads is the credit relative to the spread. What I mean is if you have a $1 wide spread and you're getting 10 cents, if you bump that to a $2 wide spread, generally speaking, you're not going to get 20 cents. You're going to get 18 cents. And while that is more than 10 cents, 18 being more than 10, it's the credit relative to the spread, which is the full risk of the trade. And so the wider the spread gets, the less, generally speaking, the less return on spread you're going to get. Right. And when you get less return on the spread, you're actually increasing the risk, the net risk, because you're getting less credit. So what I would say is compare doing, assuming you're using multiple contracts, but I would always compare, and I do this in the trading rooms all the time, compare a $5 wide spread, what's the credit, and then look at the credit on a $10 wide spread. And would it make more financial sense to trade two $5 wide spreads, which has $10 of risk, or one $10 wide spread, and which one of those two positions pays you more money? Because whichever one of those two pays you more money is the right one to do. Now, sometimes it pays the same. You know, you might get 75 cents on a $5 wide spread and $1.50 on a $2 wide spread, on a $10 wide spread. That's the same. It's the same thing. In that case, I would just go for the 10 wide because you'll spend less money in commissions. But 9 times out of 10, the more narrow spread traded multiple contracts would actually net you more money in your account than just trading a wider spread. Generally speaking. And I'm just going to try to pull up. I just pulled up the SPX for fun here.
Sure.
I don't know. Who asked that question?
That was from David.
David, what's up, David? So I don't know how far out you're normally going or anything like that, or how far out in time, how far out in strikes, and it's after hours. So right now the spreads are atrocious on SPX.
Oh,
so
sorry,
never mind. I was gonna do some analysis, but when you look at the at the money 4470 put and it's trading 610 by 3610, we can't really analyze that right now.
just a little wide.
Just a little outside.
All right. Well, cool. Hopefully that helped you out there, David. What else did I have here? What else was? Oh, there was a good one that came in from. This is from Thomasina. I know Thomasina has been eagerly awaiting this question. So I'm shifting gears here a little bit. For those who don't know, maybe joined us a little bit late. Corey is working on launching a hedge fund, and that should happen here very, very soon. We actually have a couple other guests who have been starting up hedge funds, and maybe someday we'll do a panel kind of on the ins and outs and fun parts, or even the dramas of starting a hedge fund.
Love it.
Why not, right? It's something that's we hear about it, but it's somewhat foreign to most of us, the retail people. So here's the question from Thomasina. I'd like to know more about how hedge funds structure their business. I know that most hedge funds charge $220, which is 2% maintenance fee and 20% on the profits. My question is, when do they take that 2% upfront, or when a client cashes out? Also, do hedge funds have their clients sign that they must stay enrolled for a certain amount of time, basically locking them in? And finally, are there any books that you may recommend on this? Because I'm sure that you've been hitting the books on this, Corey, and studying to make sure you get it all dialed in, right?
Books, not so much. I hired some of my favorite attorneys. I've got 5 attorneys on.
This is an oxymoron of favorite attorneys.
Yeah, favorite attorneys. They send me bills all the time.
Love them.
No, but I have so like books. I've never researched books. I've known a couple of different hedge fund traders. I know one other person that actually owns and manages and runs a hedge fund. And I've known him for many years. But I've personally never been much of a bookworm in general anyway. I am always just go straight to the source. And attorneys are your best friend when it comes to setting up a hedge fund. And there's specific attorneys in that area to set it up to help set up your limited partnership, which is the fund itself, and then your LLC, which is the investment management firm itself. And so you've got multiple entities you will need to set up in order to even think about running a legitimate hedge fund. And the attorneys are responsible for building out, which I'm sure they're pretty much boilerplate, except for each hedge fund has their own terms, like what you originally mentioned, which is 2 and 20. What's your fee structure? What's your lockup time? What's your, when can you make investments? How much money can you pull out? When you pull it out? Those things are hedge fund specific.
When you say hedge fund specific, hold on a sec. When you say hedge fund specific, there's boilerplate template, but you could modify that. You could say, instead of 220, I'm going to do 110, right? Or is that kind of frowned upon in the industry?
Oh no, absolutely. In fact, you need to, because 2 and 20 is no longer the standard. Oh. It used to be the standard 2 and 20, and some guys are still charging 2 and 20. I've researched a number of different hedge funds, but for our fund we are launching is going to be 1.5 and 20. And so we did that because 2 and 20 is a little less standard, and you can do what's called side letter deals with people. It's just like, hey, well, this person's bringing 80 million to the fund. Can you lower the 1.5, right, to 1? Yeah, we could do that. But you want to use those side letter deals sparingly and stick to the offering documents and subscription, dialogue as often as possible. So we wanted to be, because we're going to be, raising capital here in the next 4 to 6 weeks. We want to raise capital and be competitive, and so we reduced our fee structure to 1.5 and 20. And so, but as far as like other hedge funds, some are still sticking to 2 to 20. Right. Some may go to 1 and 10. I mean, I don't know every hedge fund's deal, but then the second part of that question is when do they take those fees? And that's also going to be dependent upon each hedge fund's strategy. So there's hedge funds in real estate that are not going to really be as liquid as an options hedge fund or a stock hedge fund. So if you're in a real estate hedge fund, that's your lockup time frame is going to be a lot longer. But for our options hedge fund, which is primarily what we're going to be focusing on, is option trading. Ours has a 90-day lockup period, for instance, meaning you have to stay invested for 90 days, and you could pull money out after 90 days, but you can pull money out 25% of your capital at a time once a quarter. And the reason we do that is because if someone wanted to pull out all their money at once, that could very negatively affect positions that we're in if we have to liquidate
Forced to sell
option positions, forced to sell because somebody wants to take their money out. But we are a very active hedge fund as well. Like all of our options positions will likely turn over once a month, once every 2 months. So we can have a shorter lockup period than some other funds that might have longer dated positions. And as far as like when those fees are paid out, our 1.5% is taken out quarterly based on net asset value of the fund, assets under management.
Right.
And then after 1 year's time, so our performance allocation, which is the 20% of whatever profit we make, we're analyzing that annually, so that we have the whole year to do really well before we take any sort of performance allocation or performance fee.
Nice.
That's our structure, though. So it's we've been advised that that's really great for somebody who's as active trading as we are, but somebody talking to an attorney may get a little bit of different advice if you're, looking at, longer term investing in illiquid products, which there's plenty of hedge funds out there that do that.
Yeah. Saba has asked, is it strictly for options? Yes, this hedge fund will be strictly options.
Options on equities and indexes. Yep.
Nice. With that, I think there's a question came in earlier, but it is interesting. You're dealing at that scale, you're dealing with such volume. Do you have special broker relationships? I mean, are you just going to be a standard, Thinkorswim client, or is there a special kind of team that works with you? Because I imagine someone's got a $50 million account is going to be treated way different than someone's got a $20,000 account.
Yeah, for sure. And we did a lot of research on that. I'm a huge Thinkorswim fan, by the way. I've used Thinkorswim for almost 17 years, and I was really hoping that I might be able to continue using Thinkorswim for the fund, but it's ever since TD Ameritrade and now Schwab took over, it's becoming a little bit more retail than ever. And I don't even know that they're really accepting hedge fund clients anymore. But one of the biggest factors in choosing our broker of choice for the fund, which is Interactive Brokers, is Interactive Brokers reporting for our administrator who handles all of the client-facing relations. They provide performance reports monthly. They provide annual reports. They do all of that, and they work with our third-party auditor to make sure that we are, staying, whatever performance we are claiming is not our claim. It's our auditor looking at our records from Interactive Brokers to show, here's where the fund was at the end of month one. Here's where the fund is now. And, making sure that all of our trades are matched, and they're going to do our taxes at the end of the year and all that fun stuff. And so why we choose Interactive Brokers is because they're probably the number one prime broker for hedge funds globally, likely because of their level of reporting and the detail of reporting that makes the administrator and the auditor's job easy. We looked at a number of different prime brokers, and that just was the best fit. Almost every fund that I've ever come across and known uses someone like Interactive Brokers for their stock options, futures, and Forex trading. So
bummer, you got to move away from Thinkorswim, man.
Yeah, well, I'm going to do all my analysis on Thinkorswim, because no one beats Thinkorswim when it comes to their risk graphs and analysis. And so basically I'll model everything out in Thinkorswim and just execute in IB, which I've done for years as well. I mean, I had an IB account for the longest time, and, it's going to be really great for what it is that we do at the fund. And I've used IB, so I'm very familiar with it. So I've got no problems with it. Our commission structure at IB is a little higher right now than it is at Thinkorswim for the other fund, the private fund that I manage, but I have no doubt that we're going to get to same level of commission structure just due to the sheer volume that we're expecting within the first year of trading.
I'm excited for you, man. That's a pretty big endeavor.
It is. It's like kind of like it feels like I've been kind of wanting to do this for a very long time. I originally thought that I'd get into trading and start a fund to help musicians and entertainment, folks in the entertainment business, and to really kind of focus on helping those guys out. And just knowing my experience in entertainment and the music industry, when you get a record deal and you get a publishing deal and you get a signing bonus and they say, don't blow it all in one place. And of course you do. You do. And then you don't see any money. And it's like, how great would it be to be able to take this skill set of trading and investing and apply it to a fund and work with entertainers and musicians and artists to make that money last, so that they can continue making music and they don't have to go get job type jobs. Now, I mean, if that hadn't happened to me, then I wouldn't probably be trading right now, but I'd certainly love to be able to, help other entertainers and musicians and, folks like that who have a tough time in their own line of work, do something like that. But, this is going to be set up for pretty much anybody. So I know a lot of people in the music industry that may want to be a part of the fund, and many people who aren't part of the music industry.
Nice. Got any musicians in the crowd? You might get some assistance over there from Corey and his
Never
fund.
know.
Never know. The
never know.
Next American rock star. California asked any questions. Did you have to acquire any special licenses to start a hedge fund?
No. Oh. Shockingly, no.
Yeah, I kind of thought you were going to say yes. I thought you actually did have to get some licenses.
No. Now, that's no ... There is limitations on how much money you can have under management before you have to start getting licenses. And I believe that number, I need to double check this, but I believe that number is 150 million under management. Once you reach that amount of money, I believe then you do have to start getting some licenses due to the amount of money under management. But until then, no.
Oh. Well, We'll worry about that bridge when you get there. 150 million. Not bad.
Yeah. Year one. Here we go. I'm going to have to get licenses now. And I mean, actually, if we raise 150 million year one, that would probably be a little bit too quick.
Yeah. Yeah. You need to scale into it.
Our initial cap raise is going to be 20 to 30 million, and then we'll pause there for a moment. So
yeah. Nice. Tom asks, do you deal with gamma exposure? He says gamma exposure is a hot topic among some of my trading groups. I know. Is it something that you look at?
I mean, I look at gamma from a perspective of how quickly will this position work for me or against me. That's actually the primary Greek that I am kind of leaning on if I'm just net buying a call or buying a put. Is I'm actually expecting gamma to work for me if I'm just buying a call or buying a put, which is the primary reason why I tend to buy out of the money options if I'm just buying a long option position. Because you buy a cheap delta, but gamma really accelerates the speed at which you make money if you're right, and decelerates the speed at which you lose money when you're wrong. So I do use gamma for that. But if you're short options, gamma is really going to work against you. So I don't really lean on gamma when I'm short options, but I do lean on gamma when I'm long options. And there is something that that I haven't explored a lot, but one of our partner brokers at Traders Army is Tradier. Tradier has a fantastic commission structure, but they have a great platform, TradeHawk platform, and some of the stuff that they've started to expose us to a little bit is how market makers use gamma. And I'm going to really murder this, so I'm only going to say this, and then there's a whole presentation on it. We did a summit last year in Irvine, and there's a whole presentation on this where they use gamma to actually build positions to force prices to like hedge market maker or portfolio positions, which would then help force prices to a certain strike price. It's kind of like Max Payne, but using gamma. I have not dove deep into that at all. But there is something to that in the market maker space, but I have not a lot of experience with that.
You've got what works for you. I think that's the important part.
Yeah, I mean, there might be some interesting stuff there. It is definitely something on my short list of things that I really want to kind of look at, because in his presentation, it was really kind of intriguing how he said market makers will use gamma to determine how much delta they need to blah blah blah, and then that would, if you need to be more long or more short delta, that can drive prices to certain levels. And I'm like, oh, that's interesting. I've never heard of that before. So it was extremely intriguing, but there's been a lot on my plate to really dive into that subject. But there is something to that, Tom. I'm not extremely well versed on that yet.
But you'll get there.
We'll get there.
What else is new? Anything else you want to share with our audience? I know you guys were, the last time I had you on the program, I think you were giving away your content on your website, which I thought was interesting. What else?
Giving away. That's right. We give
away.
We give a crap ton of stuff away. We still give away all of our on-demand content. So that's just a free membership over at Traders Army. Two things we have going on promotion-wise right now, if you care. If you're not a member and you want to become a member or try it out, we are, what is it? Today's what, Wednesday?
Wednesday the 12th.
Wednesday already?
Yeah.
So until this Saturday, we have half off pro membership for 6 months.
Woo-hoo.
Which is pretty rad. That's like our longest half off promotion ever. So that's half off, 6 months, $450 up front, and then you get the next 6 months is just covered. Cancel after that if you want, or maintain it, and you can maintain the membership. And that's roughly eight trading rooms a week, plus any special, sort of courses that we're doing, like one-off courses. We did one a little while ago on portfolio hedging and a stock repair strategy. Well, that's included. The other thing we got going on coming up that I'm starting August 1st, I'm relaunching again. August 1st is a program, as a series we call Options Deconstructed. And it's exactly as it sounds. We take one subject in options. We got 15 lessons. I think it's 15, 16 lessons. And so it's going to be 1 hour a week for 15 weeks, deconstructing everything in options, from the basics to all the option Greeks to the evolution of option position Greeks, all the way up to, your vertical spreads, and iron condor, which is going to be the most probably useful strategies in your option career. And you can purchase that course standalone, $249, and it's yours. And you can watch the archives and attend live when we hold it. But as a pro member, if you do the pro member deal, then you get that included. That's not an extra. We just include that to all of our pro members. So those are like the promotions that we have going on. And I saw you brought the website up there for a second, Merlin.
Yep.
So we have the half yearly sale link at the top, and then under the how we teach menu is the options deconstructed.
Yep.
You'll see options deconstructed. If you go to that page, then you can sign up for that, $249 one time, or become a pro member, and it's just included. You can show up and you'll have access to all the archives. So find out whatever value is most fitting to you. $249 for the course, or $450 for 6 months, and get the whole course plus 8 trading rooms a week. So those are the two promotions we have going on. And then, of course, we have the hedge fund launching August. It is probably the time frame, but attorneys and getting accounts all set up is taking a lot longer than I thought.
Yeah, it'll take a while, but you'll get there soon. I look forward to the inaugural announcement, the maiden voyage, if you will. And who knows, we might have some investors out there that want to kick in.
Yeah, we are one document away from the attorneys to launching this damn thing. So
one document, man,
one document away. Actually, we're wiring instructions from our bank away to launching this damn thing. So that's what we're waiting on. Bank account, brokerage account, done. And then
off to the races.
Go.
Sweet.
Off to the races.
I'm excited for you. It's interesting seeing you progress over the years from just options and instructing to now your own school and now becoming a hedge fund guy. Exit the industry, I guess, on a high note.
Well, exit. Come on, this isn't my final.
No. I mean, exit like from the education side. Now it's
Oh no, we're still going to be doing that.
If this hedge fund, if your hedge fund gets to be a couple $100 million, I don't know if you're gonna have time to be educating. Yeah, that's a big.
I don't do none of that day trading crap that you do. All right,
I don't do much anymore, man. I'm too busy.
We put options positions on and we just kind of relax and kick back. I mean, you'd be surprised, or maybe you wouldn't. I don't know, but how little work we actually do. Until
don't say that to potential investors. Come on.
No, well, it's true. I mean, you could do it yourself technically. I mean, that's kind of the approach, right? It's like, hey, at Traders Army, we can teach you how to do it, or at Mainstage Capital, which is the name of our fund, at Mainstage Capital, we could do it for you. And we have members, we have students who are like, yeah, I'm going to manage my $25,000-$30,000 account, but you manage my $500,000 account. So it would be kind of a combination of both, which is cool.
Nice. All right, man.
Yeah.
Well, it's been a couple months since we had you on. Glad we got you back on. Hopefully we'll get you on again here soon before the maybe by the end of the OC Fair, which starts this Friday. That means it's another month out. So
OC Fair, that's right. My boys are playing the fair at the beginning of August.
I'd be pretty excited about that. Pretty soon you just be a band manager for your kids. It's got to be fun.
Oh,
when they go,
my wife does that.
Oh, that's nice. Oh boy. Yeah.
I just manage the music side. I make sure they sound good. She manages all the booking side.
The exciting stuff. Good. Well,
the exciting stuff.
I'm glad you get
but let's do this. Let's do this more often than once a month or once every other month, shall we?
Sounds good to me.
There's actually a lot of questions in here that I missed. So if you want to give them can I give them my email address?
Of course, whatever you want. Give me your phone number if you want. I don't care. It's all you.
Actually, the phone number is on our website, so they can actually text us to that website number. We do have a phone number here. Yeah, but if you want, you can. I'll type in the chat box, and it's just like, hey, if I missed your question, because there were some good ones in there. There's only so much time, right?
And Tom says, Corey, make Merlin do spreads. maybe I'll just have to jump into Corey's rooms and start doing more spread trading. I'm such a simpleton when it comes to options. People mock me for it, but I don't care. It's working for me. So
I'd say whatever's working for you.
Exactly.
I'm not gonna make you spread them, Merlin.
Yeah. Oh, but I'm dumb. All right, dude. Hey, well, thank you very much. I appreciate you coming on. If I don't see you before then, I'll see you in August when your kids play at the fair, because it's right down the street from my house. And
right.
Thanks for the education on hedge funds, options, and the options nitty gritty. Our topic is yours. Thanks, man.
Nitty gritty. Love it. Thanks, guys.
All right, bye.
Thanks.
As I was Corey Lane of Traders Army, I will bring up that webpage as I just had up there a second ago. You can just go to tradersarmy.com. They got some promotions going on. Their half yearly sale. That was an interesting one. And Options Deconstructor, it seems like several of you have utilized that and found some good information out of there. So glad you guys enjoyed today's show. I'm going to real quickly run through our markets today, and then I'll wrap up because, again, I've got just a bazillion things going on, although most of my presentations have been done for today. If we look at what was movers out there, Bitcoin down 1.17%, really not that big of a deal. I mean, I look at the chart here, and it's just kind of meh, not exciting to me at all. Still stuck in the sideways range, so we'll move on. This one is very interesting. We talked about how the dollar index, once it broke that 102 level, I said probably going to head down towards that 100 mark, which is this blue line. And now we have eclipsed that, falling really aggressively today. Now it's at 100.57. So a pretty impressive slide there for that dollar index. You'll notice that there really isn't anything here below that blue line that should act as a demand zone. Right, you've got a little tiny thing over here at 130, and then all of a sudden it starts to look like a much bigger fall to the south side. So that head and shoulders pattern that really started back in April of 2022, it's still not broken, right? It's still actually intact. It's just that right shoulder looks a bit awkward, but now we're starting to see that follow through to the downside. And we had some pretty positive news out there from the data perspective for those who weren't paying attention today. We had that CPI number come out. Wow, what a shocking number. We went from 4% year over year. They thought we were going to go at 3.1. Came out at 3.0, which is a pretty impressive drop, a full 1% decline year over year. That's awesome. And the markets rejoiced on that. That's why we saw some of these other markets. You saw the 10-year tank. The percentage is off. It's at 386 right now. S&P was up 0.76%. It also broke above that upper 4,500 mark, which was kind of the high point that we've seen it established back in 2022. Was up to 4,507 is where it closed. That's 0.76% gain. Russell was fourth place with a 1.07% gain, but just smoking outside that 1930 range on the Russell. NASDAQ also surging. This was, I mentioned yesterday, I just felt like it's building up like an ascending triangle here, and we broke it today, although it didn't have convincing follow-through above the highs from the 16th of June, right? The high on the 16th of June was 15,475. Today, our high was 15,550. So we broke it, but we're back down below that right now. Crude oil, 1.23% gain. We are right up into that area of supply that was mapped out right up to about $76. Your intraday high was $76.15 on crude oil, posting 1.23% gain. Awesome. And finally, commodities soaring with that tanking dollar. You had gold up 1.27%. You had SLV, which is my number one holding at this moment, ripping up as well. Was up almost 4.5% today. Woohoo! 22.14 is where silver closed the session on, looking really good for SLV. And that is your market recap. Let's see. Did I got burn a couple of my USD? Yeah, it was a volatile day for Forex. So that's going to do it. As far as tomorrow, oh yeah, one other thing here I wanted to show you. I wanted to go to, let's go and look at the Fed funds futures, because remember I mentioned yesterday, if we get that really low print on the CPI number, that might lead traders to shift their belief about rates. Well, they really didn't. It actually seemed like it, there it is. Here's your change for today. It actually increased. It felt like more people felt that they were going to continue to raise rates. And I don't see the need for them to keep raising rates if inflation falls and looks like this right here. I mean, this thing's screaming back down towards 2. If this is any indication, within the next 4 months, we'll be back at 2%, which is the target by the Fed. Right? It's fallen from 5% to 3% year over year on inflation in 4 months. Actually, 3 months. Which means in 2 months we could be at 2%, and then all of a sudden stop. I sold the puts on coin, so yeah, I'm fine on it. I never got executed, but my options expire next week. So for that Coinbase, right there's your Coinbase. I wish I would have bought it. I didn't. I sold I think my strike was the $50 strike for the puts on Coinbase. So I'll just collect all that premium. No big deal. As far as the announcements for tomorrow, since John says, what's the announcements for tomorrow? Here's your major economic news for Thursday. You have the PPI numbers come out. So, of course, the CPI is the most important one. Well, not really. PPI to me is very important. What's interesting here is they do not give you a year over year for PPI. You have to extrapolate that from the month over month, which is weird. They do it for CPI, but not PPI. That number comes out tomorrow before the open. You also have other data. You've got natural gas storage. You got the 30-year bond auction, federal budget balance, and unemployment claims coming out tomorrow. So it's a pretty big day for the U.S. Other markets, you don't have too much going on. There is a GDP estimate coming out for the British pound, which could create some action there. But that is pretty much it for that. All right, I'm going to wrap things up. I hope you enjoyed that with Corey. If you have things you want me to discuss or go over, I went through most of the questions that came through. I think there were a couple that I wanted to get to that I didn't get a chance to get to today, but time permitting, I will get to those on tomorrow's show. But let me know what it is you want to discuss tomorrow. You can email me at TraderMerlin@gmail.com or go down below any of the YouTube videos, send in your comments there, which is where most of these comments were sent in today, was done on the YouTube channel. So thank you for those that sent in the questions. Glad you enjoyed Corey. I agree. He's just a great guy. I love the direct, simple approach that he gives, and I hope that you learned something on today's show. Hit that like button, share it with some friends, and I will see you guys on our Thursday show. Take care, everybody. I don't have an outro anymore. Something happened to all my settings. I'm just going to have to go to a piece of fire like that and call it a day.